Imagine operating a multi-billion-dollar business for 10 years with absolutely no idea whether the product you were selling was legal. It sounds like a bureaucratic nightmare. But on the 17th of March, the SEC and CFTC ended a decade of darkness by issuing a landmark document that classifies major crypto assets as digital commodities. Many see this as the ultimate regulatory green light for the industry, but buried inside their new token taxonomy is a hidden trap designed to hand Wall Street a multi-trillion-dollar monopoly. My name is Guy, and you're watching The Coin Bureau. Okay, let's begin by taking a look at the landmark document that just dropped. On the 17th of March 2026, the SEC and the CFTC issued a joint 68-page interpretive guidance establishing the first formal federal token taxonomy for crypto assets. If you read the mainstream financial press, then the headlines are entirely focused on one massive victory. They'll point out that the agencies have officially split the market into 5 distinct categories and clearly labeled assets like Bitcoin, Ethereum, Solana, and XRP as digital commodities. They'll highlight SEC Chair Paul Atkins standing on stage at the DC Blockchain Summit, declaring that the SEC is no longer the, quote, Securities and Everything Commission. To the average retail investor reading the news, this looks like the total surrender of the regulatory state, completely reversing the Gary Gensler era of regulation by enforcement. For context, between April 2021 and December 2024, the SEC initiated 125 cryptocurrency-related enforcement actions, resulting in a staggering $6.05 billion in penalties. So the official story is that the war is finally over, and the path is now clear for a massive wave of new spot ETFs beyond just Bitcoin and Ethereum. But if you look at the actual data and the market's underlying reaction, a very different picture emerges. Because while the headlines say the entire crypto market is celebrating, the price action tells us exactly who the real winners are. Following the announcement, Bitcoin remained relatively flat, hovering around $74,000. But Ethereum surged 13% over a 7-day period, and Coinbase stock has skyrocketed by more than 28% over the past month. The market is aggressively pricing in the exact legal safe harbor that institutional investors have been waiting for to enter the altcoin market. By explicitly defining what is not a security, the SEC has removed the existential threat hanging over the top blue-chip altcoins. But this is only looking at half the picture, because the real threat isn't what the SEC classified as a digital commodity, but the dragnet they just built for everything else. And speaking of staying ahead of these massive regulatory shifts before they hit the mainstream headlines, this is exactly why you need the Coin Bureau Telegram channel in your life. It's where we break down these dense 68-page SEC documents so you don't have to. We provide deep dive alpha and give you the most important market updates, all pinged directly to your phone so you don't miss a thing. Whether it's a hidden clause in a regulatory framework or a massive institutional ETF filing, our members see it first. So sign up today using the link down below or by scanning the QR code on screen. And now back to the token taxonomy. And here is how it works. The new joint guidance splits crypto assets into 5 buckets: digital commodities, digital collectibles, digital tools, stablecoins, and digital securities. The first 4 categories are explicitly deemed non-securities, freeing them from the crushing weight of federal registration. But the 5th category, digital securities, remains fully subject to strict federal securities laws. And let's be precise about what is actually happening here. If a decentralized protocol issues a governance token that distributes revenue, pays out yield, or retains centralized voting control, it falls directly into the digital securities bucket. Under the Howey test, any mechanism by which token holders receive a portion of protocol revenue triggers the expectation of profits prong. Put simply, if your token pays a dividend, it is a security. And the compliance cost of being classified as a digital security is absolutely crushing. We're talking about hundreds of thousands of dollars a year just for baseline compliance before you even factor in legal fees, audits, and reporting systems. This forces DeFi projects into a brutal binary choice. They must either strip away all economic utility to become a single digital tool, or face the full wrath of traditional financial law. And the market knows this is a death sentence for permissionless innovation. Just look at the data for the top DeFi governance tokens over the last 3 months. Aave is down 30%, Compound has dropped 21%, and Uniswap has fallen nearly 20%. The market is actively pricing in the existential risk of these protocols being retroactively classified as unregistered securities. But there is one glaring anomaly in the DeFi space, and it proves exactly how this regulatory game is going to be played. Over that exact same 3-month period, Maker, now rebranded to Sky Protocol, has surged by 44.5%. Why? Well, because MakerDAO deliberately restructured its entire ecosystem to straddle both the digital commodity and regulatory compliant worlds. They launched a dual token strategy and executed a massive $102 million treasury buyback using compliant stablecoins. They built a compliance filter, in other words. But that's just the plumbing. The harder question is what this means for the future of the multi-trillion-dollar tokenization industry. Chair Atkins explicitly told reporters that a formal rulemaking proposal is dropping in, quote, a week or two. And buried in the preliminary guidance is the framework for how traditional assets will be tokenized as digital securities. This is the legal highway built exclusively for Wall Street. The label tokenized does not change the legal character of the underlying asset. Months before this taxonomy was announced, the SEC issued a no-action letter allowing the Depository Trust Company to tokenize US Treasury bills, bonds, and major equity indices. JPMorgan's blockchain platform, Kinexys, is already processing over $2 billion in daily transaction value. The total on-chain value of tokenized real-world assets has already exploded past $25 billion, and in February 2026, BlackRock announced it was bringing its treasury-backed digital token, BUIDL, onto Uniswap. But before you get excited, you can't just go there and buy it. The smart contract automatically rejects you unless your wallet has been explicitly whitelisted by Securitize, BlackRock's registered transfer agent. They're using decentralized permissionless infrastructure to distribute a fully regulated, KYC-gated, permissioned financial product. And that brings us to the bitter irony at the center of all this. The SEC's new taxonomy is the ultimate compliance filter. It clears the way for trillion-dollar asset managers to tokenize the world while simultaneously threatening to regulate native DeFi governance tokens out of existence. Wall Street doesn't need to invent new compliance infrastructure because they already have it. They just put their existing regulated securities onto a blockchain, lock out the retail users, and call it innovation. I guess even decentralization has a price tag. So, the SEC and CFTC's new taxonomy is undeniably the greatest single regulatory victory in the history of the crypto industry. On the one hand, it completely removes the existential threat hanging over the top blue-chip altcoins, and it opens the floodgates for institutional capital to flow into spot ETFs for Solana, XRP, and others. On the other hand, though, this clarity comes with a catastrophic structural cost. The incoming formal rulebook is designed to integrate crypto into the traditional financial surveillance state. They aren't surrendering to decentralized finance. They're simply drawing the battle lines for the tokenization war that's to come. But what do you think? Is this new regulatory clarity the catalyst for the greatest altcoin season in history? Or is it a Trojan horse for Wall Street control? Let me know your thoughts in the comments down below. If you want to understand exactly how Wall Street is building KYC directly into smart contracts, well, you can check out our video on that right over here. And if you want to dive deeper into how institutional ETF flows are impacting Bitcoin's base layer, well, you can check out that video right over here. Okay, thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.